funsupermart.com.
What is your outlook on equities in the current uncertain environment?
Equities have to be looked at from a longer term perspective. It is true that we've had an uncertain period since 2008 after the Lehman debacle, and the world economies are going through certain major adjustments. Now, this is going to take a while to unravel and sort out. In the meantime, the Indian economy is passing through the twin challenges of fiscal deficit and current account deficits, and that's also going to be dependent on the ability of the government to take action to control them, and at the same time whether the external inflationary forces come down, which should, in my view, over the medium to long term, that's 3 to 4 years, due to the expected slowdown in current commodity intensive countries like China and a general slowdown across the world including USA and Europe. The major negative factor facing India, which is commodity, should come down, and that together with the fact that government intends to target subsidies to the end beneficiary through the Aadhaar scheme is going to be a factor which is going to moderate the fiscal deficit. The fact that the government is going to get revenues from resources by way of auctioning of spectrum or coal resources, etc., is also going to add to the kitty, and therefore there seems to be a possibility of correction in fiscal deficit going forward. And the slowdown in our economy should be looked at positively because excessive consumption was leading to inflation and was leading to higher current account deficit and a pressure on the currency. So I view the next coming years as attractive for Indian investor.
In this volatile market, how are you positioning your flagship fund, that is DSP Top 100?
In the volatile market, the large cap fund, which is the top 100 companies fund, affords us flexibility to move the portfolio to suit the volatility. And the sectors which are recently most benefited are those of the export sector, like IT and pharma, and those companies which are import substitutes, say metal companies for example. Now the realizations of these companies have tended to improve. The outlook for them has definitely improved, and our weightages to this sector has gone up. Obviously the metals and commodity sector has a lot of headwinds in terms of global slowdown, so has the IT, but the fact is that you have to choose the right company which is well positioned in terms of its leadership, in terms of its balance sheet, and in terms of its business to take advantage of this situation. So in general, we have repositioned it to benefit a weaker currency. However, the volatility is such that we have to actively position our bets. We are a bit underweight on the banking sector because it has challenges of lower growth because of a slowdown in gross domestic product, and it has challenges of non-performing assets, and therefore these twin challenges may keep the performance muted. The consumption sectors are now seeing fatigue after many years of strong consumption, and the valuations perhaps don't justify, are not justified by this recent fatigue, and therefore we are keeping a close watch. We are slightly underweight the consumption space as well. The infrastructure space is something that requires clearance of hurdles, one of them being interest rates. So if the interest rates do come down because of this slowdown globally, and therefore subsequent fall in inflation, like oil prices having fallen sharply, then there may be a revival in select consumption which is dependent on borrowing money, say the automobile, and select infrastructure. However, that space has many issues related to the policy, and we are watching the policy environment very closely.